everybody, Eleanor and Jazz here from Nesta Invest, and you are watching Hot Property Q&A. Questions asked by you, answered by us, so you can gain more knowledge and insight into the property world and beyond. Now, the question that we're going to be answering this week is fixed or floating? Is it better to have a fixed or floating interest rate on your mortgage? Now, depending on your mortgage and your mortgage goals, you may want to pay your mortgage off in a short period of time or over a longer period of time. But in either of these options, sometimes the interest rate can really add up. So it's definitely something to consider whether you are looking at buying a house right now for the first time, or perhaps you still have a mortgage at the moment, but with all those new interest rates coming up, that might be an option that you're looking at. So like I just mentioned, there are a lot of competitive interest rates now at the moment that are coming out, and they're a lot lower. Do you think this is because of COVID, or is there any reason behind this?
No, I don't think it's because of COVID. Interest rates have been going down since probably maybe 10 odd years. So
Wow.
It's progressively going down. It's been a little bit sharper recently, but yeah, it's always been going down. And I think it is going to be getting lower and lower as we go over next year and year or two. So yeah, it will keep going.
Oh, that's something positive to keep in mind.
Yeah, definitely. If you're buying property,
Yep.
it's the best time to buy.
100%. So in terms of that fixed or floating, what would your preference be right now? You know, we've got those lower interest rates. Would you go for a fixed or floating mortgage?
Just depends on people's perspective or what their situation is. If you're, for example, unsure of what you're going to do, whether you'll be downsizing, upsizing, or if you're trading, for example, I'd just stick to floating. And if you are, you know where you're going, you know, you're thinking long term, I'd stick to go fixed interest rates, even
Okay.
for a little while, because
Yeah.
I think it'll keep going lower over the next couple of years. But yeah, I'd fix for about a year or so.
So let's pull that back a bit. So I've asked you fixed or floating, and you've kind of given me two options. So why don't we look at fixed then at the moment? So you've said fixed if you're looking at longer term. Can we talk about that?
Yeah, so fixed longer term, I mean, yeah, I'd fix it for a year or a year or two. I think we're still looking at sub 3% at the moment, and it'll keep going down. So yeah, there's no doubt it's a good option.
And so would that be for if you're, say, having a property and you want to keep it for, you know, the next 5 years or 10 years or 2 years?
Yeah.
So this is more an investment, or if you're living in a home.
Yeah, and at least you know what your mortgage is going to be. I
Yeah.
think that's a big factor. Like, you know what it's going to be. But then again, when I say that, I'll bring floating into it.
Okay.
So then again, if you're looking at, oh my God, I'm going to sell the property, what would I do? So I'd keep it then sitting at floating.
Okay.
If your interest rate is looking to expire, only because when you sell a property and it's on fixed term, you'll end up paying break fees from the
Okay.
bank. So you want to avoid that at all costs.
So a break fee is when you break your mortgage. So if it's a fixed mortgage and then you break it, you have to pay a penalty. Is that
Yeah,
it?
that's right. Especially with the interest rates going down, the bank is committed on, say, 3%, for example. And if the interest rate, when you break it, is going to be 2%, the bank has to recoup those losses for that period of time because they've already committed a year or so, whatever the period is remaining.
Okay.
So they will charge you, and in some instances, it can be quite heavy. It could be in the tens of thousands,
Yeah,
depending
well,
on your
that's
mortgage.
quite a lot, and that would really add up. So it's not just a couple of thousand; it could be $10,000 or $20,000, depending on how much your mortgage is.
Yeah, so just got to be careful there as well.
Okay.
So it's not a one size fits all. It's dependent on situation.
Okay, so like you're saying, I just want to kind of go over that. So perhaps fixed for more of a 1 year or 2 year plan, if you actually have a property that you're holding on to.
Yeah.
And floating if you may be looking at downsizing in the next 2, 4, 6, 8 months, or you're a trader.
Yeah.
And you buy and hold and you just want to sell the property.
Yep, that's right.
Cool. And
Yeah.
you did talk about that break fee, which is, you know, a bit of a risk. So are there any other risks around fixed or floating that you can think of?
I think break fees is one of the biggest ones. With floating interest, one of the risks used to be, like, the interest rate could go up. So at least when you capture it at a low interest rate, you're fixed and you know what's happening. But in the current market, interest rate won't be going up for at least a couple of years that we can see. The whole economy, the whole world's pretty much going down. Look at Japan, for instance. Japan's got negative interest, last I heard. So,
Really? Wow, that's not bad.
Yeah.
Wish we could get there in New Zealand.
yeah, it's got good and bad effects, but we can go into that later. But yeah, generally it will be going down for the next couple of years at least.
Okay, so I guess in terms of, other tips around interest rates, I know that we've done this on our own personal home, is splitting
Yeah.
your interest rates. How does that work?
So splitting is, say for example, if you've got a $500,000 mortgage and you're unsure of what you want to do, you're thinking de-risking it. So like we've done, we've split 50% into 1 year because we've got a good 1 year rate, and then we split 2 year so the other half into a 2 year.
Okay.
So we split our risks. So when one expires, for example, if it's 3% at the moment, next year it'll be 2%. So we can fix that again for another year. And then when the 2 year expires, we can fix that or see what we can do.
Yeah,
there.
so
Or we can even make it floating. So,
Yeah, well, there you go. So there is a little bit of de-risking in that matter.
Yeah.
Yeah, and again, I think it is a personal preference. I mean, if I think about it, 4 years ago, our mortgage was 4%, and at that time we thought that was pretty good.
Yeah, I
and
think
now
we were sitting at 5.
Now it's 5, and now it's 3. So it does change. There's no crystal ball, is there?
Yeah, true.
Yeah. So something you just have to, I think, look at your situation and really figure out what's going to work for you. So I guess if I sum that up, then, we're talking fixed if you're going to be holding on to the property for a bit longer, and floating if you are thinking of selling or you're doing trading and you might not hold that property for less than a year.
Yeah, and in the scheme of things, I think if you're looking at it, and it depends on what you mortgage it could be $50 extra a week versus it's not a very huge cost, So yeah, just need to look at each and every situation and each and every where you sit in the risk profile as well.
Yeah, so looking at all those aspects is definitely helpful. So that is the answer to our question, a short summary, fixed or floating. Definitely look at those options. Now, if you have any questions, do let us know. We're always happy to help and answer questions that you have about property. You know where to find us. We're on social media, Facebook, Instagram, LinkedIn, YouTube, and of course on our website, nestainvest.com. I hope that was helpful. We will see you again next time. Bye.
Bye.